My name is Marty Kehrman. I'm the partner in charge of our tax credits incentives advisory group. Welcome to the webinar today, which is called Navigating the R&D Tax Credit Landscape. Today, we're going to focus on disclosure requirements. This is a Q2 update. We're going to do 4 of these this year. I think this couldn't come at a more timely time. It's timely, we'll put it that way, due to the fact that we have not only some new disclosure requirements coming up in 2025, but it's along with some potential legislative changes that we see right now. And so there's a lot going on. It's R&D is one component of what's going on in law, but let me finish the opening. So today's webinar, as I mentioned, we're going to discuss the Form 6765, including new documentation requirements and eligibility criteria effective in 25. We're also going to cover strategies for maximizing your research credits, such as identifying qualifying expenses, maintaining proper documentation to assure compliance. I can talk a little bit about also what we see on the audit sort of landscape right now with the IRS. But with that said, before we get into too much more, let me introduce you to the other person on the panel today, Vivian Kors. Vivian, why don't you do a nice introduction for yourself?
Yeah, thank you, Marty. Well, nice to meet everybody. I'm a partner in the R&D credits group, and I work very closely with Marty. I'm specialized in everything R&D credits related to Section 174 R&D capitalization. So all things R&D, I'm the fun guru that goes around telling people what to do.
Very good. So I'm going to start at the beginning here, and I'll cover a few things. And I think probably you'll hear more from Vivian than from me. So I'm sure more people will stay tuned in as a result of that. But again, we're going to talk about the proposed legislative update around R&D, specifically both the House and the Senate version. I like the Senate version better for our clients. I've been thinking about this from a practitioner standpoint as well. I think the Senate version is what I'm kind of hoping passes. I think it's better for everybody. Vivian's going to talk a lot today about, this is unrelated to the legislation, the Form 6765 and the newly issued documentation requirements, where you'll see information that has to be reported right on the form. This is kind of in line with what we saw for amended returns that began, I think, like January 11th of 2022. The IRS is asking us to do more work for them, essentially, and that's not necessarily a bad thing. It just means that there's work to do in order to get that on the return appropriately. And we're going to talk about amended return disclosure statements as well. But sprinkled throughout this, we'll talk about a number of things that I think may be timely in terms of what we're seeing right now. Let me talk a little bit about our group. Our group is called Tax Credits Incentives Advisory. We are within an overall group called Strategic Tax, which is made up of the International Tax Group, State and Local Tax, or Strategic Financing Services, which has somewhat of a focus on the new markets tax credit. And then overlapping with them a bit, because it's a credit, we have TCIA, Tax Credits Incentives Advisory. We are focused on your R&D credits and your R&D capitalization. We're focused on your real estate and construction incentives, specifically Section 179D and the cost segregation studies. We're also focused on things that were Inflation Reduction Act specific, like investing in alternative energies and both investment tax credits and production tax credits that are generated through those investments and production of either certain property or electricity, or just overall looking for a site selection to the extent you have negotiated incentives that come up, and also some statutory state incentives that kind of go along with all this. Specifically, they tend to be related toward hiring. So when it comes to all things tax credits and incentives, we take a wider view than just the R&D, but we're going to do the opposite today. We're going to take a smaller view and really just focus on the R&D, because this is what the point of this webinar is. You've probably been tuning into a lot of different webinars on the overall legislation. I'll talk a little bit about some other areas, but we're primarily going to focus on R&D. All right, so we do polling questions, right? So this is a CPE thing. So here is polling question number 1. How'd you hear about us? A Cherry Bekaert tax advisor, an email from Cherry Bekaert, a friend or colleague, Cherry Bekaert alum, or a social media post. I'm always curious to see how people join these things a little bit, because I think our presence has become, I don't know, a little more strongly stated when it comes to content that we're putting out. I think as a firm, we're doing our best to make some nice strategic investments in people that are focused on our legislative updates. We're trying to do our best to get that out to all of our clients and non-clients, and maybe with a little forward thinking planning that goes along with that. All right, we'll leave the poll open for as long as I'm supposed to. I really don't have control over it, so I'm just kind of filibustering here, but we'll see. We'll see what happens. It went away. All right, cool. Email from Cherry Bekaert. That's good. So all those emails I sent out, people answered them for a change. Excellent. Cool. Well, let's keep going. All right. All right. Potential legislative update. So just background, in May, the House passed its legislation. The Senate has not, but the Finance Committee has issued some legislation, some proposed legislation for those of us professionals to review. I think the hope is that something will be passed before the July 4th. But we shall see. This is a very expensive and a very tricky. There's a lot of different people that want a lot of different things, and it's also very expensive. So even though there's only one party in power, as always, but in terms of the Republicans, and it's going to be a reconciliation bill, it's just a lot to get through. And so we shall see what's going on. But let's talk about Section 174. This was me, Vivian, still, right? Or did you want to? I can't remember. Okay, very good. So beginning in 2022, as part of TCJA back in 2017, I think December 2017 it passed, effective 2018, but kicked in 22, taxpayers began to have to, could no longer currently deduct their expenses specific to research and experimentation, which are kind of those expenditures beyond just those that go into the R&D credit. R&D credit is kind of limited to your wages, your supplies, your contract research payments, and potentially some cloud hosting costs. There are a whole other number of expenses to be considered that are R&D adjacent or just R&D specific, but not credit includable. And as a result, taxpayers since 22 have had to identify those expenses along with doing a research credit analysis. They have to also capitalize and then amortize their expenditures, both either over 5 years for domestic R&D or over 15 years for foreign R&D. Eligible small. Oh, and then okay, so that's the beginning. Okay, so that's where we've been, and that's everyone has been hoping that it goes away or it goes back to something similar to what it was back in 2021, which at the time allowed you three options. One, the de facto option was generally you could deduct your expenses specific to R&D currently, and so you would get a credit, and then you would also get your sort of currently deducted expenses, almost no different from your Section 162 expenses, ordinary and necessary business expenses, but they were separately stated as R&D. But 174 gave you flexibility to either elect to deduct them currently or to elect to amortize them over either 5 or 10 years, depending on which code provision you used and when you did that. So 174 expenditures were inherently flexible, and you could use them to sort of manage your overall tax position and your attribute position and the utilization of them. The House proposal went back for a temporary time for 5 years, from 2025, 26, 25, 26, 27, 28, and 29. So 5 years, you get a temporary reprieve from what we currently have for domestic R&D, which is the 5-year amortization of the capitalized expenses. The foreign R&D expenditures would have to continue to be amortized over 15 years. And as a result, people found their taxable income going up, right? And now in the House proposal, as I said, you're going to see it going back down. People are going to be in a really good position currently, although the foreign continues to stay amortizable over 15 years. I think I said that right this time. Okay. The Senate version came out, and it was similar but better because you had, in addition to what I just described, the ability for taxpayers to either do a sort of retroactive expensing on amended returns potentially for the 22, 23, and 24 tax years, or do, we'll call it amortization acceleration, beginning in 2025 for the unamortized domestic R&D that stayed on the books. Take all of it in one fell swoop in 25, or split it over 25 and 2026. With that said, I think this is sort of the big hopeful thing that we're going to have to bring to our clients, which I'm bringing to you today. But it's in the Senate bill. What we really want to focus on is looking at companies that are small. Small company for this purpose is defined as having fewer than 31 million in gross receipts, and you do that on an annual average prior 3 years. So you look at the gross receipts from the prior 3 years, average them. If it's under 31 million, you have the ability to go back in time and redo your R&D 174 capitalization and take current deductions in those years and file for refund claims if that's applicable. The issue is like whether or not companies are really going to want to do that, or they want to take the time and expense to go back and do amended returns. They may get some interest payments from the government, considering that that may have been available to them back in the day. I got to look into that a little bit, but for the most part, I think these smaller companies can evaluate whether or not they have a desire to go back and amend returns, as opposed to just doing catch up accelerated amortization deductions right now. But they can also go back and look for more credits if they didn't substantiate or identify them all in prior years, without fear of identifying more that has to be capitalized. And so I think it's time to like take a nice clean look back in 22, 23, 24 for these smaller companies to see what R&D may have been overlooked, and also take that accelerated, take that expensing back in those years. Alternatively, larger companies may just want to keep it simple. Look at their unamortized, for all companies may want to keep it simple. Look at their unamortized expenditures on the domestic side and take it all in either 25 or split it over 25 and 26. This is a huge opportunity to look at and make potentially just an accounting method change in 25. And that will either be on a Form 3115 or potentially on a disclosure that is allowed. We shall see, but it gives an opportunity for us to work with our clients to take a really fresh look at their accounting methods, shall we say, and understand what they've been doing for R&D and what that current immediate expensing, accelerating that amortization will do for them. It will have a massive benefit to the extent we're having a tax liability. They can combine that. If they're a C Corp, they combine it with maybe purchasing credits out there that are Inflation Reduction Act specific, et cetera. It provides a lot of planning that we can offer to clients and modeling out exactly what their taxable income will be or would be under either 1 or 2 year scenario. So keep in mind, you're going to be hearing from us a lot to the extent this thing passes as it is in the Senate proposal. I think it's exciting. I think everybody on here, please feel free to reach out. If we're not already working with you on R&D, we're more than happy to, we'll call it like do a free scoping and analysis and see where you are from an accelerated, for where you would be to accelerate that amortization and what your accounting methods look like.
And Marty, we have a good question in the Q&A section.
Good. Well, this is the Marty filibuster, so let's keep it going. I'll pass it on to that. What's the question?
Yep. So if smaller businesses go back and amend to claim R&D expenses, so basically go back amend to deduct instead of the capitalization, will these lead to audits of these amended tax returns?
Let's see. It could. I think that there'll be so many that the IRS will be somewhat overwhelmed, but in my opinion, I wouldn't be afraid of it. I would just, I would say this, especially if you're not going back and putting in more R&D than you had before. I think if you're just going back to do what was previously capitalized, it's hard for me to say the IRS would really view you as a target too much, because it really is timing. It's not really anything permanent in that sense. But I would also, again, encourage you to take a fresh look at what you have from a research credit perspective. And I think this is just clearly the time to do amended returns for additional research credit, should you actually qualify for it, because the rules have been established in terms of how you do that, what disclosures you need to be made. People are going to be making them for currently filed returns, but also you'll do it on these amended returns as well. The process is in place now. I think now is the best time ever to take a look at it. So they could, but I, again, wouldn't be afraid of it if you have a good professional on your side. It's a great question. So anything is possible, but it's not, I would just take the fresh look.
There's no direct correlation, I think is what you're trying to say.
Yeah, it doesn't trigger an audit, right? It does not trigger an exam at all. And I think, again, there's going to be so many coming in at once that you don't want to do it because the IRS is overwhelmed. But at the same time, it's harder to be a target when there are so many going on at once.
Yeah.
Okay.
And also, if you are going back and amending to get more of your R&D credit, just make sure that you and your company are, or your tax professionals are helping you prepare the disclosures that need to go on to that.
Yeah, absolutely. And that's what we're going to be talking about a little bit later. Disclosure, right? That's the whole big deal. And that is, they're going to be talking about it a lot for the currently filed returns beginning in 25, but we'll talk about a little bit about what we've had to do since 22 as well. If you don't do it, you're not going to have a valid claim. So we should do it.
Yeah.
With that said,
Marty, we have two more questions. You are so popular.
well, nobody likes
Only in this house, let's be
slides,
honest.
so it's just this is good. What's up?
All right, if you're not an eligible small business, you can only do option 2. You want to go back to the other slide?
Yeah, that's correct. And everybody can do option 2, right? But only eligible small business can go back and do option 1. What would be a good scenario to do it? I don't know. Let's say you I don't know, you're in losses now, but you wouldn't have been then, and you paid tax in that prior year. You can go back and file for a refund. I want to be clear, it won't be extremely quick to get that refund. The IRS is somewhat backed up. So
That goes to our question number 2.
count on a
Someone's
year.
asking, someone's asking, can we expect delays in receiving refunds like during COVID if there are a lot of amended returns being filed?
It won't be that bad. Because this is income tax, and I think those COVID refunds were specifically the delay ones, were those employee retention credit ones. And that was the most overwhelming thing that I think has ever happened to the service, because suddenly everybody decided they were an ERC expert who wasn't, and were advertising it, and everybody knew about it. And so everybody was filing for it and not really doing any work to see if they qualified. This is very different. Unlike the ERC, where you just stuck a number on a return, here you actually have to do disclosure, and you have to show the IRS exactly the number of business components you're claiming, what the R&D is about a little bit, whether that's current or in the back years. So I think the processes are in place for a faster refund process than existed in COVID. So cool. Are there any more in there, or shall I just keep going?
Nope. You say, so we hope, right, Marty?
Yeah, we'll see. Well, yeah, no, I just don't think it's going to be anything like you saw for the COVID ERC stuff. Okay, so I'm gonna do some of these, but you'll see that there are other things on here as well, and I want to get into them too much. But one of the things that we deal with in our group are the bonus depreciation rules. Tend to give a larger return on investment when you're doing what's known as like a cost segregation study. The more you can identify as bonus, much better to categorize it so you can get faster depreciation. It's down to 40% bonus on the TCJA phase down. The House version bumps it back up to 100% for structures that began construction after President Trump was sworn in. So it's oddly tagged to his time in office. The Senate version also has a January 20th beginning date. I think it's a little more unclear whether it's begun construction or placed in service. We'll see what these final rules look like. But I think that's a pretty big deal in my world. Kind of along with that is Section 179, different than 179D, which is sort of the overall depreciation allowances, which are generally allowed, kind of similar to the overall amount of credit that's allowed on a return. One of the other things on here one of the things not on here in the Senate version was, from an energy efficiency standpoint, Section 179D is proposed to be repealed. It was strengthened significantly under the Inflation Reduction Act. That's the energy efficient commercial building deduction. That is a deduction that's sort of commensurate and goes along with the square footage of a building that you have, and then you get it based on the investments you make in HVAC and interior lighting and building envelope, and do an energy modeling study to see exactly how energy efficient the building is. To the extent it meets a certain threshold, the amount you spent on those improvements are deductible. It goes really along hand in hand with a cost seg study. It's proposed to be eliminated 12 months after the enactment of the law, should something like the Senate version pass. We do a lot of that, and so I would be sad to see that go, because I think it's valuable to companies that are placing the service commercial buildings. But again, I think there'll be a phase out on it too. So don't be too scared about how it may affect you. It will be available for a while. There's also quite a bit of controversy over the Inflation Reduction Act credits, specifically those for solar and wind, and those that are transferable. The House version is much more onerous than the Senate version. I don't have time necessarily to go into all the differences there, but the Senate version is better for preserving some of them and preserving transferability for a longer period of time. Transferability, for those who don't know, generally speaking, like Inflation Reduction Act energy credits, for those that can't utilize them, they can sell them on an open marketplace. That's been a huge deal for C corporations that have wanted to go out and purchase those credits. The other thing on here is the PTET changes, basically the SALT workaround rules, essentially. Those were, PTET was kind of pulled out completely out of the House bill, and now it has been put back to a lesser extent into the Senate bill. So it won't be fully repealed, but there will be limitations. The Senate version, like, basically, I'm trying to read it for you here. Yeah, it would allow pass-through business owners to deduct the individual SALT deduction, which is currently capped at 10 grand. We'll see where that ends up. That's a big thing going on in this legislation as well, plus an additional amount based on their PTET allocation. The additional amount is the greater of 40,000 or 50% of the PTET allocation. That's a big deal for partners at accounting firms that use these rules to deduct more than just 10,000 of state and local tax. It specifically hits high tax blue state accounting firm partners. So thank you. Anyway, anybody has any questions about that? I don't have any answers. So let's move on a bit. Oh, last thing, the employee retention credit. This is a big deal. So in order to potentially bring in more revenue, the House version proposed to eliminate the employee retention credit, at least retroactively change the statute of limitations for its to being no longer to file back to January 31st, 2024. That was then pulled out of the House version, thinking that it wouldn't pass the reconciliation process in the in the Senate parliamentarian. It was put back in the Senate version with some different language, but it is only specific to claims. I'm trying to do this off memory. Claims for quarters 3 and 4 of 2021. So here's the deal. If you filed accidentally after January 31st, 21, and it's for quarters 1 or 2 or 2020, actually, for quarters 1 and 2 of 2021, but not quarter 3, you're okay. Right now it's on moratorium, but you will be okay, and this legislation won't prevent the IRS from looking at that. That was nice for some of our clients. I was not happy with the fact that they sort of retroactively change the filing date, even though they hate ERC. Everybody thinks it was oversubscribed. It was, but that doesn't mean that if you claimed it and you deserve it, you shouldn't get it, especially when you were following the law and there was and you were within the statute of limitations. So I think most of our clients who are still waiting or filed after January 31st, 2024 will be okay. All right, let's move on. Polling question 2. Are you an eligible small business looking to retroactively deduct your previously capitalized 174 costs? And again, yes is a great answer. No is a great answer, depending on what your specific situation is. But that's the point. We kind of want to work with you to figure out what makes the most sense. See if there's other deductions and credits that may be available to you as well. Knowing, though, that this will be a big deal. There's a quick process that we can get into place to do amended returns for you. And again, I think speed is the issue here. If you can go back and do those amended returns, you find them quicker than other people, you'll probably get them processed quicker than other people too. Hopefully, that's kind of the hope. With that said, so yes, no, I'm not sure if I'm an eligible small business for this purpose. Again, eligible small business is a business that had 31 million, or really less than 31 million in gross receipts on average in the 3 years prior to the current tax year. So in 3 years prior to 25, you'll kind of know that pretty well off the top of your head. Gross receipts for this purpose will follow the definition as they are normally under the traditional credit, which is not just your sales, but also including your dividends, interest, rents, royalties, other income, sort of like line 1C on 1120, plus everything else on the front there. Those are your gross receipts, not just your sales. Okay. How long is this polling question going to be open? Because I'm running out of words. All right. So, no, you are not. That's fine. That means you're going to focus on the other thing. Some of the companies that we're not happy about identifying all this capitalization will be very happy to take it all back and get these current deductions in 25 and or 26 per what they want. All right, Vivian, take it away.
Sounds good. Well, honestly, the Form 6765 reporting requirement changes has been the most exciting thing I feel like in the R&D credit world that has happened. And again, this doesn't count 174, right? Because 174 is not R&D credit. The last time there was a form change, Marty, can we jump to the next slide? It's really around when they introduced the alternative simplified credit method. So that was years and years and years and years ago in like the early 2000s, I want to say. So this is a big change in the world of R&D tax credits. And really the change is driven by how the IRS wants to, I could think twofold. One wants to weed out some of the bad actors who are just throwing numbers on the tax form, because that's what the old form allowed you to do, it's just a bunch of numbers, you're throwing it up there, you don't tell them what you're doing, how you're doing it, and things along those lines. And it's just numbers that the IRS can't really look into. So a lot of the reporting requirements is closely aligned with how the IRS is currently examining research credit calculations, as well as more in line with filing your amended returns for refund claims related to R&D credits. So there's a shift to more and more requirements on the face of the Form 6765. So if we jump to the next slide, we can kind of dive into things a little bit more. And we left the link up there so you can take a more detailed look at it. But in addition to more disclosures, right? The IRS is looking, hey, are you guys part of a controlled group? So controlled group in this definition is either a parent sub where the parent owns more than 50%, or a brother sister controlled group where there's, I think, was it five or less members who own more than 50% of the different entities. That's all part of the same common control. So if you are part of a control group, you have to check a box and kind of attach a statement that shows you are. This is kind of tricky because technically you could be part of a control group and only one entity within that control group has R&D credits, in which case you still have to check this box and prepare that disclosure statement, because technically this entity is part of a control group. It just so happens that all of the R&D credit falls in a single entity, so you don't have to allocate it. But if more than one entity within the control group does generate qualifying research expenses, or QREs for short, you're going to probably hear me say that multiple times, then you are required to allocate the credit out based on each entity's contribution to the current year qualifying research expenses. So if entity one generated 40%, entity two generated 60%, then entity one gets 40% of the credit, entity two gets 60% of the credit. Section A and Section B, which is also what the old form had for regular credit and alternative simplified credit, respectively, they no longer contain the lines that show each bucket of qualifying research expenses. It just kind of shows the total number. That's not really the big change. I think the next two slides are probably going to talk about where the biggest changes are. And Marty, can we jump to the next slide, please? Thank you, thank you. So Section G, so I lied. It's the slide after this that will jump to the biggest change. But other changes include whether or not your company is a small business, or your company is making the small business payroll tax election, and if those entities report their EINs on a different, they report their payroll taxes on a different EIN. That's a box that needs to be checked. Previously, you kind of just, there's no way to, I guess, confirm that. So that's something important that we need to make sure we're double checking now is, okay, which entity generated the QREs and which entity is actually paying the payroll taxes? And if those are different, if, for example, you're using a PEO, make sure that you're checking that box so that the credits can be flowed onwards accordingly. Section E is completely new, and this is important. So previously, taxpayers never had to report the number of business components that are generating the qualifying research expenses. So business components in this sense, I would think more kind of around like project groupings or platforms if you are a software company. So kind of think, hey, is everything that I'm doing on a single tech stack and it's just different features? I would say that's probably a single business component more. And again, it depends on the facts and circumstances, but I would say that's probably more likely going to be on a single business component. Or is it, you're working on a process development as opposed to a product development and you're doing both? Just make sure that you are working with your consultants, hopefully us, to figure out the number of business components because that's going to be important. Whatever you're putting on the face of the 6765 is effectively your declaration to the IRS of what it is, and they can disallow whatever it is based on the Form 6765. Second part is identifying the officer's wages that's included in wage QREs. So this wasn't a requirement to report this previously, but to the extent you have an officer who maybe you have a flatter organization who's very hands-on doing R&D, just making sure that their wages, their portion of the wages that's included in the wage QREs are reported on Section E of the Form 6765. They also want to know whether or not you're doing any acquisitions or dispositions of a major trade or business in the tax year, because the IRS wants to make sure that if you are, and it's giving you a huge bump or a drop in current year QREs, that you're accordingly doing the right thing to the base year, so you're comparing apples to apples. And again, the R&D tax credit is a credit for increasing research. So it's important that however you're calculating your current year QREs or your qualifying research expenses is exactly the same methodology as how you're calculating your base year, which generally would be your prior 3 years of qualifying research expenses, so that the appropriate way of calculating your base is correct. It's also similarly, it's also asking if there are any new categories of QREs for the same purpose, because they want to make sure that if you've suddenly identified that you now have cloud hosting costs and you previously didn't claim cloud hosting costs, and there might be those types of expenses or qualifying research expenses in the prior years, they want to make sure that you are doing the appropriate base adjustments. So these are all ways for, I think, the IRS to flag returns potentially for an exam. Lastly, it's asking whether or not these QREs are calculated under the ASC 730 Safe Harbor Directive. It's really just a checkbox if it is, if it isn't. And again, it's just for the IRS to identify these new types of information. Section F, which is new, is now kind of, remember earlier when I said Section A and B, where it no longer asks for the identification of the different buckets of qualifying research expenses. This is where Section F is where it's reported now. So QREs are broken down into what are wages, supplies, contract research, or computer rental, in which case nowadays it's more cloud hosting costs. Section G. So everything that we've kind of talked about now is what's on the new Form 6765 and is required for the 2024 tax year. Section G, however, Marty, we go to the next slide, is optional for 2024 tax year. This is probably the biggest change and going to be driving most of your reporting requirements in the new year. So this starts, yeah, go ahead.
Interrupt for a second. This is called our practice year, right? So yes, it's optional, but we're always doing this anyway when we do our analyses. So it's not particularly onerous to the extent you hired us or maybe some other reputable provider to do your research credit work. It's just the timing of when it's filed. You can't stick it on a return and then true up your documentation later. It's a matter of getting it on the thing. So it's going to change the timing, but for our staff internally, again, I say that we do this all the time. It is in our deliverables, but it's accelerated the work that we do this year because we're trying to practice to get it done on time, like not after the fact, but before the fact. And so I'll leave it at that, but we're ready to the extent it's necessary to get this stuff reported in the time that is required.
Yeah, and it's important for you to take a look at, to the extent you're not working with us, to take a look at your maybe 2023 deliverables, or if you're done with your 2024 R&D studies, to take a look at those deliverables and make sure that the deliverables are capable of answering these questions. Because I would say 9 times out of 10, if your deliverables can't answer these questions, the processes in which your preparer has come up with those numbers aren't there, and you need to revamp your processes significantly to be able to generate the information that the new Form 6765 would require in the new year. The good news, though, is that, and I think this is the part where the IRS did listen to taxpayers, or tax return preparers, because they did have kind of like a comments period, and a lot of the comments that they've heard is, hey, Section G is onerous. What about small businesses? Can there be a threshold so that you don't have to report this? The good news is Section G for 2025 tax year is optional for qualified small businesses that are using the credits to offset payroll taxes. So one, if they're making that election and they're eligible, then it's Section G could be optional for 2025. The second part would be Section G is optional for taxpayers with total qualifying research expenses that are less than $1.5 million and their current year gross receipts are less than $50 million. So that's the good news. Also, for taxpayers who maybe have a lot of business components, the taxpayers are only required to report 80% of those QREs, business components by order, or no more than 50 business components. So if you have 100, you could potentially be just reporting up to 50. Some of the new business component information that the Form 6765 is requiring is the business component name. So what is the project name? What the business component type is. So is it a formulation? Is it a product? Is it a process? Is it a technique? Those are important for you to choose, because the IRS could come in and say, hey, because you were, developing a technique, like in the information that you provided doesn't meet the 4-part test because of XYZ. So it's important that your preparer is aware of the different types of business components and to break out the different types of business components by the different business components. Because, for example, if you're developing a special syringe, for example, and you need the manufacturing process for the syringe, you should be breaking out the business component into 2 business components so that you can list both out and break out the qualifying research expenses between the 2 different business components. There's also a breakout of the different types of qualifying research expenses by business component. So again, right, make sure that your current R&D study process is capable of addressing this. If not, we're happy to help you guys revamp your process. We do this all the time, and make sure that you're up to par so you can comply with the new requirements. Even if you think Section G is optional for you in 2025, it may no longer be optional for you in 2026. So it's better to address this sooner rather than later. And for those people who are not doing a full study, or for those people who are doing their R&D credits by themselves, I would recommend having a professional look at it, because it is important. This is what's going on the Form 6765 and what's going on your tax returns. So it's important to look at it now. It also requires your wage qualifying research expenses to be broken out, not just by business component, but be broken out by the types of activities. So whether or not it's direct performance, direct support, or direct supervision. And that's really more and more around the case laws that have come out. So again, go take a look at your processes, your work papers, and your deliverables to make sure that everything that they're doing now, you can address in the new disclosure requirements in the Form 6765s. And I think the next 2 slides are the actual Form 6765, so we can take a look at that. Again, we left the link in the slide deck so you guys can go and take a look, because I know this is kind of small, but the next slide is where all that fund reporting will go on the return if it's not optional for you. Marty, one more slide, please. Thank you, thank you.
Oh, no. All right.
Oh.
Did I go too far?
All good, all good. I guess we can do the poll while we kind of talk about this.
Yeah.
So it's looking for a lot of information, including, I honestly think the most important is what your business component is and what are you doing to said business component. What's the information that you're seeking to discover? And a lot of this is very much in line with what the disclosure statements that are required for the refund claims are doing too. So the general theme of the IRS asking for more and more information. So the third polling question is, does your R&D process collect the information necessary to fill out the new Form 6765? Yes, no, I'm not sure. And again, we're always happy to help take a look at this for you to make sure that things are up to par. We do this for free, so feel free. And I saw a few people who have raised their hands in the group. Feel free to throw your question in the Q&A box. That's kind of the only way we can see it. I don't think we can allow people to come off mute. So
I would also suggest, even if you're doing this perfectly, if you want to kind of yell at me a lot to get it done for you, people like to do that. So we'd be happy to do the work for you. You should see some of the emails I get. Anyway, there we go. Okay, yes and no. So that no and I'm not sure. Yes, you're the ones that can yell. No and I'm not sure. You can work with Vivian. This is great. Okay.
So jumping forward to the amended disclosure statement. So this is not necessarily a new thing. And Marty, if we can kind of jump to the timeline, I can walk through the timeline.
There you go.
So around the same time that I joined Cherry Bekaert, the CCM released, hey, by the way, here are some new requirements that require all of these things that need to be reported if you want to file an amended refund claim starting January 10th of 2022. So you can only imagine the mad frenzy between October 15th and January 10th of 2022, people trying to file all of these refund claims. So starting January 10th, 2022, the requirement for research credit refund claims to include this disclosure of reporting that 5 additional items, and I can jump to the 5 additional items later, that kickstarted. The IRS said, hey, we're going to give you 45 days to perfect the claim to make sure, because this is a new requirement, it's quite onerous. We want to make sure that you have the timeline and that you are aware that we're not processing your refund claim because you're missing this information. They've extended that 45 days for, I want to say, maybe 5 times now. So the latest extension is now through, or this transition period, even though we're in year 3 or year 4 now, is through January 10th of 2026. So taxpayers are going to be notified, hey, here's a 45 days for you to perfect this claim because we're missing the information that's required for a research credit refund claim. And I want to be very specific in that this only applies to research credit refund claims. So only to the extent that you're amending your prior year returns to get a refund as it relates to R&D tax credit. So if you're amending for ERC and you're not touching your R&D credit, the refund is solely related to ERC, then you don't need to provide this additional information. What I do want to point out, though, is that the IRS obviously is not perfect, and we have seen taxpayers get this 45-day letter, even though that they didn't touch their R&D credit and it wasn't a refund claim for research credits. So again, just work with your agent or the folks that denied that claim or sent you that 45-day letter to make sure that they are aware that this is not a research credit refund claim. Good news for C Corp taxpayers who are in losses, who have always been in losses. We can go back and look at your R&D tax credits for as long as possible without having to amend your prior year returns, meaning if we are claiming your prior year returns, it's not really a refund claim because you've never paid taxes. So we're just adjusting your credit carry forward schedule in the current year. So again, this is very specific to research credit refund claims to the extent this thing applies to. So if we jump to the next slide, we can kind of see, hey, what are the 5 things that the IRS asked for? So you can see, what are all the business component names? What are the research activities? And the names of the individuals who are performing each research activity and what each person was trying to discover. The good news is, of the 5 things, they struck out 2 of the more, I would say, cumbersome things, because they are no longer asking for the names of the individuals who perform each research activity and the information each qualified individual sought to discover. As you can imagine, those resulted in, I mean, some of our old research, some of our old disclosures were 45, 60 pages, maybe even longer. So again, they heard the taxpayers and the preparers, and they did make some adjustments to it. Otherwise, though, if it's just listing out the business components, the research activities that were performed on each of those business components, those are things that at the very minimum, your R&D experts should be doing anyways. A lot of what they should be doing concurrently when they're doing an R&D study is to gather all of this information so that in the event of an audit, you guys have everything ready to go, as opposed to going to figure that out. What they did 3 years ago, there's probably significant turnover. Even if it's not significant turnover, one key person who holds the information is gone. A lot of times that information is gone with them, and you don't have what's necessary to really substantiate the R&D credit claim. So again, if you get that 45-day letter, make sure that you're addressing that within the 45-day window. That's extremely important, or else they basically say, hey, you have insufficient information, we are disallowing this claim. And if your statutes are closed, you don't get to claim that again. So that's extremely important.
It was
Marty.
amazing to see how many, despite very clear instructions to file this disclosure, we'll call it other CPAs out there to do it, they would take our work and just do it and file it, would not do it. And then they get this 45-day letter and not tell us about it. And so it was, and then they missed the statute. So Vivian's right. It's incredibly important. And they're giving you a gift here by giving you some time. If the statute expired, but they're giving you a 45-day letter to extend it a little bit. Shouldn't happen though. So for the most part, we're used to it here. We can't file anything without disclosure anymore. So here's the takeaway. If anybody's filing anything on a current or past return without a disclosure about what you did in your business components and your costs associated with them, it's not right. And so it's an easy thing to know now and identify.
Yeah. And Marty, can we jump 2 slides from here? I think it's important to kind of talk about the trends and the issues that we're seeing.
Absolutely. For you.
So this is what we hear from a lot of our peers, is that they're seeing a whole host of issues around these amended refund claims. A lot of them, they obviously experience processing issues, right? So they have sent the disclosure statements, but they still get the 45-day letter. And it's such a generic letter. It just basically says, oh, you're deficient in your information that you supplied. It doesn't tell you why it's deficient, what areas are deficient. So it's impossible to kind of address what they're needing. Some of the other issues that we see is the timing of the 45-day letter. So taxpayers won't get this 45-day letter until after the 45-day has expired. So again, as we know, the IRS is not perfect, and there are significant issues around this. So just make sure you're staying on top of this. Make sure your preparer, your R&D tax credit study experts are staying on top of this so that you get the money back. Because sometimes it's significant dollars, right?
Right.
I guess there are no open questions.
I'll say one more thing. Yeah. So, okay.
Yeah.
Do you believe you have unclaimed or underclaimed prior year R&D credits that we can help you identify? I hope so. If not, and you know, we know we're willing to, and we can do it. We'll scope that out for free and just figure out what makes sense for you to go forward. We do talk to peer firms, and we're both from the Big Four as well. And so I have a long history with the IRS in terms of like how they look at these R&D claims. I think it's kind of hit or miss sometimes. I think a lot of practitioners out there getting hassled a little bit by the IRS, but I think that sometimes it really doesn't feel that different to me than it has for the last 15, 20 years, to be honest. I think some people are just newer to it maybe, or aren't used to it, because it's the same thing that is happening in the mid-market that's happened at some of the Big Four before. You got to be prepared. And so if You can identify by industry what the specific technical uncertainties are that you're focused on and make a case about like why this is R&D, and you're not just lumping a bunch of costs in there, which is the whole point of what we do in this business component rollout and shrinking back the unqualified stuff. You'll be okay ultimately. There may be a process there, but you should be filing for the research credits to which you're entitled. And should all go well with the House and or Senate versions passing, you will not be subject, at least for a period of time, to the capitalization that has been so onerous. And I think kind of a little bit unfair to people who perform R&D in the US and get hammered for and have to like capitalize that stuff and have a taxable income go up. All right, so you believe you have unclaimed? Yes, that is 8% of you, which is 8. We'll be happy to reach out, or you'll be happy to reach out to us, either one, to see if we can help you. No, great, not sure. Also happy to take a look. Not applicable to us. You may not be in an R&D industry, or you may not have claimed in those years. Very good. I think that's it. So we're through our 50 minutes, right? I believe
Yes,
so.
we are. But there is a question.
Okay.
So is there a definition for officers? And I assume this is going back to, officers wage QRE being reported on the Form 6765. I don't believe there are specific definitions of officers. The way that I would go about it would be the officer's comp that's reported on your tax return. Those individuals would make up what you need to report on the Form 6765 to the extent that they generated wage QREs.
Very
And
good.
I believe that's all the Q&A we had.
So that's going to conclude our webinar today. Thanks for joining. If you have any questions, as I've said, please reach out. We're very lonely. We need friends. We're happy to talk to any of you. We value your feedback. Ask you to take part in a short survey, which is going to appear after you leave the session. Just a reminder, recordings are going to be available in about a week. Thank you, everybody, for joining us. This has been fun for us. We like to communicate with you about what's going on out there. So thank you. Take care.
Thank you, Marty.